Good afternoon, everyone. Thank you so much for tuning in to our Investing for Kids webinar. It's wonderful to see so many of you on the webinar today. Thanks for tuning in over your lunchtime. I'm sure you're all quite busy. We're very excited to be presenting this webinar today. We think it's a very important topic. So for those of you who don't know me, my name is Sarah King. I'm Head of Client Care and Advice at Stockspot, and I'll be joined today by Hannah Hooper, one of our investment advisors, and we'll be going through today's presentation. If you're a parent tuning in, a grandparent, an expecting parent, we're hoping that you'll walk away with a ton of information today. And we're going to have the opportunity to go through lots of questions and give you all the information you need so that you are well equipped for investing for kids. So a little bit of an outline of today's agenda. So we're really going to go through what is investing for kids, why do we do it, and how does it actually work with Stockspot. Hannah's then going to take you through the many benefits of investing for kids. And we'll then go through some common questions on investing for kids, as well as leave plenty of time for some live Q&A at the end of the session. So just want to check in there that everyone can hear me okay and that you're all connected and okay. Is there anyone there? Okay, I'm just going to reconnect my camera. So I think there has been a little bit of a timing delay. Can you all see me now? Some thumbs up in the chat section would be wonderful. Fantastic. Thanks very much, guys. It must have been the internet here at our office. So look, I'm sure you all heard the agenda for today. I'm pleased you can all now see me. Wonderful. All right. So as I said, so let's have a quick chat about some housekeeping. So we've got a Q&A section over there. Please post any questions in the Q&A, and we will endeavour to get to as many as we can at the end of the session. If we can't for any reason, don't worry. We will follow up with you in person afterwards. We are recording the session today, so if you have to drop off for any reason, don't worry. We'll send you a copy of the recording. And just a quick note that today's session is general advice only. We haven't taken into account any of your personal circumstances, so it's not to be relied upon, as well as any of the charts that we're showing in today's section showing performance. Of course, past performance is no indication of future performance. Alrighty, so without further ado, so what actually is investing for kids and how does it work? Certainly, working at Stockspot, we have seen phenomenal growth in kids investing, and I think it was really spurred on by the COVID-19 pandemic. We saw a lot of parents at home looking for smarter alternatives for their kids, aside from traditional savings accounts and other ways of investing in terms of, putting the money in individual shares, managed funds, or, even insurance bonds, which Hannah's going to touch on a little bit later. And I think, it's great to see that there's so much interest in parents looking for better alternatives for their children. And what I thought I would talk about today and kick off with is just to show the benefit of investing over keeping money in a savings account. It really is such a fantastic way to give your kids a financial head start in life. I mean, just looking at this chart, you can see that investing money into a diversified portfolio over the long term is going to help their money grow by so much more than leaving it in a savings account. So can you imagine your kids are 21, they're coming to you asking you for money, and you've got this pool of capital that you can access for them to fund a goal, whether it's a home deposit for their education, or it may be that they want to continue to hold the portfolio for many, many years to come and give it much more time in the market. So it's really a great way to, give your kids that financial head start that maybe many of us didn't get when we were young, obviously growing up in Australia where we didn't really know about other alternatives aside from savings accounts or individual shares. Now, with Stockspot, a great thing is that investing into a low-cost index ETF portfolio means you own thousands of different companies. So you can talk to your kids about the benefits of, investing in household names like Apple, Nestle, Nike, those big global companies, but as well as well-known brands here in Australia like Woolworths. You can keep your kids engaged through accessing a mobile app and the online dashboard that we also have. I think that visibility and transparency is a great way to keep your kids engaged and learn about the value of investing. Obviously, with us, you pay low fees, and the less you pay in fees, it means the more for you or the more for your children at the end of the day. And Hannah's got some compelling slides slides that talk to that later on. But most importantly, you also get to teach your kids good money habits. We know that our, financial education system here tends to fail on the financial literacy side of things. So the more that you can teach your kids valuable lessons about money and teach them good money habits, the better. And Stockspot can certainly help you do that. Now, if we just get into a little bit of deeper detail with how it works with Stockspot, the beauty is that you can instantly access a low-cost, diversified portfolio of exchange-traded funds with us. So as I mentioned earlier, you don't need to worry about picking individual shares. You can literally get access to hundreds, if not thousands, and achieve really smooth, consistent returns over the long term. We also make sure that you get a portfolio that's suitable to you. So if you're a grandparent or a parent, depending on your time horizon and your risk profile, we can make sure that you get a tailored portfolio recommendation. As an advisor, we actually issue you with a statement of advice that outlines our recommendation. Typically, we do see parents and grandparents investing in some of our growth portfolios, so Emerald or Topaz, because they have such a long time frame to be investing on behalf of their children or their grandchildren. What we also do is ensure that you get the right mix of investments. So you want to have both growth and defensive investments in your portfolio. So the Stockspot portfolios have shares, so that's Australian and global shares, that really help to grow your money ahead of inflation. And we know that inflation is sky high here at the moment, edging closer to 7%. And investing in shares helps your money grow and outpace inflation over the long term. But you also want to have investments that protect your kids' wealth as well. And so that's the role of owning gold and bonds in your portfolio. So we have gold, and that's consider that like an insurance policy in the portfolio. It helps to cushion you in times of volatility, particularly when we're going through periods like we're seeing now. And bonds also add that level of insulation. If you are looking to invest sustainably as well, we do have portfolios that allow you to invest in a way that aligns with your ethics and values. They're climate-friendly portfolios, and we're certainly seeing that as quite an increasing trend amongst our parents and grandparents and relatives investing for children. Another good thing to point out is flexibility. When you're investing for your kids, you want to know that there's no lock-ins. You can start with a really small amount. So with us, you can start with $2,000. You can even start with less if you like and build your way up, but it will be invested at that $2,000 point, and we'll make sure that you get one growth and one defensive investment in the portfolio so that you're well diversified. And then as you continue to top up, we'll introduce the other asset classes. And in terms of top-ups, there's no minimum monthly top-up, so it can really be tailored to your needs. What a lot of our parents do is set a regular top-up amount and they automate it. So it might be $100 a month, $100 a week, whatever works for you. And you can just gradually continue to add to the portfolio. And we'll see the benefit of that and how it really supercharges the portfolio's growth over the long term. And another important thing is advice and transparency. So as an investment advisor, you actually have the option to pick up the phone and talk to an advisor, live chat us. We're actually here managing your portfolio on your behalf. So for all of you, who are parents or grandparents who might be very busy and time poor, you don't need to worry about the day-to-day management of your portfolio. We're actually making sure that your dividends get reinvested, or we call them distributions here at Stockspot. We do portfolio rebalancing as well as making tax time very easy, and all of the things I mentioned above, the right strategy. And we also check in with you annually to make sure that you're still in the right strategy as part of our annual review process. That accessibility and the ability to talk to an advisor is very important and can add a fair bit of value over the long term in terms of helping you stay on track to reach these investing goals for your kids. And then time in the market. This is very, very important. Obviously, the more time in the market, the better. Typically, parents are starting with a small amount, so the sooner you actually get started, the better, irrespective of what's happening in the market. If the market's down, if it's volatile, the best thing you can do is just start and help that portfolio grow into something bigger and more meaningful. And I'll show you the benefit of that here. So, time is really everything. This looks at the benefit of investing for your child at age 5 versus leaving it to when they're 25. And you can see that there is a massive difference there. So I know that sometimes, I speak to parents and they think, oh, damn it, I left their money in savings for too long. If you are thinking about doing it, it's best to strike while the iron's hot and get their money in the market so that they can really take advantage of compounding of returns and capital growth over the long term. And just talking to the benefit of those automated top-ups along the way. I mean, this is that same amount, $2,000 invested at age 5 with monthly top-ups of $100, and it's quite significant. You can see that portfolio growing to well over $300,000. I mean, I think we would all love that. That's a decent amount of time in the market, but really shows the benefit of starting now and not delaying. So without further ado, I will hand over to Hannah, who is going to talk through the many benefits of investing for kids as our next session today. Over to you, Hannah.
Thanks so much, Sarah. Hi, everyone. It's wonderful to see so many of you on the webinar today. As Sarah mentioned, my name's Hannah Hooper. I'm one of the investment advisors here at Stockspot. And as part of my day-to-day role, I speak to our clients about investing for kids, definitely on a daily basis. It's become more and more popular over the last couple of years in particular. So what we thought would be of benefit is to actually talk through some of the key benefits for investing for kids, and I'll talk through some of those now. Now, one of the biggest benefits for investing for kids is the powerful impact of compound growth. Now, given children typically have a long time to invest, usually years and years, the compound effect of interest and getting dividends on your dividends, it is one of the most powerful things with investing. Now, in the case of investing through Stockspot, your portfolio will actually be earning what we call distributions, which are like dividends. And as these dividends are reinvested, you'll be getting more units in these ETFs, and therefore the returns the following year will be even larger and grow, and that's that compounding effect. So with years in the market for your child to be invested, it's a really powerful way to invest your money, to beat inflation, particularly in these conditions at the moment. And what we would highly recommend is checking out Stockspot's investment calculator. Now, this can be found on the website. It's showing on the screen at the moment. And essentially, it shows you the power of starting with a certain amount, topping up regularly with an assumed growth rate, and really seeing that exponential growth, which you can see as part of this chart we've got on the screen. So we definitely recommend checking that out. Now, another benefit for investing for kids is the ability to be able to stay engaged. Now, we've got a dashboard which is accessible online. We also have a phone app. So 24/7, you can check your kids' account when you're on the run. We think it's a really good thing to keep them engaged and to show them their portfolio growing over the long run. But keeping, the dashboard and the phone app at hand, at least that way, we can really, help our kids to become engaged. Another great feature I would recommend having a look at if you set up a Stockspot account is the goal tracker. Now, the goal tracker is where you can set a goal and you can set that you might be topping up a certain amount every month or nothing at all, and it will actually show you your percentage likelihood of achieving your goal. So it's a really great tool to help yourself and also your kids stay on track to achieve their goals. Now, in terms of investing in general in a diversified ETF portfolio, it's one of the best ways to save and invest over the long run. So there's lots of different products that you can invest in for kids. When we look at the average saving rate over the last 5 years, it's returned about 2% per annum. And when we compare that to some other alternatives like traditional investment bonds or education bonds, as they're sometimes known, they have returned on average about 4.7% per annum over the last 5 years. And when you look at a diversified portfolio of ETFs in a high growth portfolio like Stockspot Topaz, which is our high growth portfolio, that's returned on average about 10.4% per annum over 5 years. Now, this data is as of 31st of December 2021. So what does this show us? Well, it shows us that investing in a portfolio of ETFs does outperform traditionally other asset classes and other investment alternatives like investment bonds. So whilst they do have some difference in their tax benefits with investment or education bonds, what we're seeing is because they typically have higher fees, it actually erodes the return over the long run. So it doesn't often end up outperforming a traditional diversified ETF portfolio. And you can see this demonstrated in the graph on our screen with the far left as the Stockspot Topaz portfolio and the other investment bond alternatives to the right. Now, another benefit of investing is keeping your kids engaged, which we've touched on a little bit earlier. It really helps to teach them great money principles from a young age, which they can take with them as they're older, like, the key principles of compound growth, and also just teaching them about the different investment alternatives out there on the market. Now, for each of our kids' accounts, we will be issuing a little investor certificate, which you can see on your left. And that's something that you can actually gift your children. And again, to congratulate them on their first investment and to keep them engaged with their portfolio. We also have a really good YouTube series, which is an educational YouTube series. It helps you to engage with your children and talk to them about investing, the key principles, and even has some fun activities and games which you can also discuss with your children. And finally, one of the biggest benefits of investing and one of the key principles when investing is keeping your costs low. So one of the benefits of investing through a Stockspot Kids account is the fact that you can actually save in fees. So we don't charge any management fees for portfolio balances under $10,000 and whilst your child is under 18. So it's a really great way to get them ahead, especially when starting off with smaller amounts. And you can see on this chart here that fees can actually really erode your returns over the long run. So if you have a look at this example, even by saving 2.5% per annum in costs, like brokerage costs, management fees, platform fees, you can improve your long-term outcome by around 300%. So that's why to get kids ahead, and particularly with our kids accounts, we waive these management fees for those smaller initial balances under $10,000. So we've covered some of the benefits of investing for kids. Now we'll move on to some of the common frequently asked questions on investing for kids. And we'll have Sarah join me for this session as well as we talk through some of these common frequently asked questions. So the first one is the account in my child's name or in my name? So this is probably the most common question we get asked around our kids accounts. So the kids accounts must be in the name of an adult, or alternatively, they can be set up as a trust on behalf of a child. So legally here in Australia, a child cannot have an account in their individual name until they're 18 years old, which is why we do have these kids accounts as an alternative. So it's either set up as an individual, so this could be a mum, dad, or a relative applying in their name. We also add an account identifier onto the account so it reflects the child's name at the end, but the legal ownership and the tax ownership is in the individual's name. Or, as I mentioned, it can also be invested through a formal trust that's pre-established, like a family or a discretionary trust. So what are the tax considerations when investing for kids? So from a tax perspective, any assessable income, so any capital gains or dividends that you might be earning throughout the year, this would be something that's declared by the primary account holder, so the individual applying on behalf of the child. So if you're investing through a trust, it's the same thing, but it would be the trust that's a taxable entity, not the child, but it's either the adult or the trust. Now, it's always best to get independent tax advice. So if you do have any concerns or questions specifically regarding tax, we would recommend speaking to a tax advisor or an accountant about this. Now, what are the options when my child turns 18? So this is another very common question. So at this stage, you have the option to either transfer the assets to your child, so they can set up an account in their name, and you can do an off-market transfer so they become the new legal owner of the investment portfolio. Now, there may be tax implications for this transfer method, and there may be some transfer costs, so it is best to, again, speak to an accountant. The other alternative, instead of transferring the assets when your child's 18 into their name, is simply selling down the portfolio. That way you can gift them the cash to reinvest in their name or to put towards something at that stage once they're 18. Now, what are the fees? And I have already touched on the fees briefly, but for kids accounts under $10,000, there are no management fees. And this is also valid whilst the children are under 18. Once the portfolio exceeds $10,000, the normal Stockspot management fees will apply. Now, we have a pricing page on the website, which I'd recommend referring to, but generally for portfolios between $10,000 and $200,000, it's 0.66% per annum. And now I'll hand it over to Sarah to cover off what are some of the most popular portfolio types for investing for kids.
Yes, thank you so much, Hannah. And I can see lots of great questions coming through on the Q&A, so we'll definitely get to those shortly. So some of you have actually pointed out what is the best type of portfolio for a kids account. As I touched on earlier, given that parents are typically investing for their children for many, many years, we do tend to see parents opting for the growth portfolio. So that's our Emerald. Emerald has a 70% allocation to Australian and global shares and 30% to bonds and gold. So you're getting a much higher allocation to that share component, or alternatively to the high growth Topaz. And that has about a 78% allocation to your Australian and global shares and 22% to the defensive investments, being gold and bonds. Typically, the more risk you take, the longer the time frame you want. So for Emerald, we'd say a minimum of 6 years, ideally longer. Like the longer you can invest, the better. And for Emerald, it's a minimum of 7 years. So typically, we will see parents going with either of Emerald or Topaz. But if your time horizon isn't as long, or you might be investing for a teenager who's say 16 and you want them to take over the portfolio in just a few years, you can take a more conservative approach. Our most conservative portfolio, Amethyst, we recommend a minimum of 3 to 4 years, but it does have that high allocation to bonds and gold versus shares. The next common question that we do get is, should I have one kids account for all of my kids combined, or should I set up a separate one for each of my kids? And this is a really good question. And look, there's no perfect answer. It really depends on your individual circumstances. I know for parents who have, multiple children, there might be a bit of an age gap, and they want to make sure that there's that segregation in place. There might be times where the children or relatives want to deposit funds into each of their accounts. So having a separate account can be handy. And what you can do now under our multi-account solution is inside the dashboard, once you've set up your first kids account, you can go in and set up additional kids accounts. And that way they're linked under the same email address. So it makes logging in and accessing those very, very easy. And that's also the same within the app. And we do actually issue each kids account with its own separate cash account details. So you'll have clear account details to deposit funds into along the way. However, some parents just want to combine, all of the funds into a single kids account to make it much easier to manage, or they might just want to put more money into the market at once. So it really depends on you and your unique circumstances. You can do whatever you like. Now, what's the minimum to get started? As I mentioned earlier, it's $2,000. You can start with less if you like. And unlike other investments like managed funds, there isn't a monthly minimum top up. You could put in $10 a week if you wanted to. You could put in $1,000. It's really up to you and your financial circumstances. And what will happen is each time the cash account gets to $1,000, it will trigger the next investment into the portfolio. So if you're topping up with, say, $100 a month, it will be invested around about every 10 months or so. Obviously, the more frequently you're topping up, it will be invested that little bit sooner. And then most importantly, how do you get started and set up a kids account? For those of you who haven't actually been through that process, it's managed via our website, stockspot.com.au. There's a big button at the top that says Get Started. You can pop in your email address and password. You'll then select that you're investing for kids. It's an account type option. And then you can choose whether you're doing it through a formal trust. So that's a trust established under a deed, or you're doing it in your individual name on your child's behalf. You'll go through and get your portfolio recommendation and then fill out the form. Won't take you too long, and we'll then set up your account. You'll have those cash account details within 1 to 2 business days, and then you can go ahead and make that first transfer and start investing into your portfolio and start tracking it and topping up along the way. Now, so that's the end of our common FAQs, and I can see a lot of great questions coming through in the Q&A section. So thank you all for doing that. So a really good one I can see from Alex here. Assuming you're starting with $2,000 in a Stockspot portfolio, when is gold actually introduced into the portfolio or invested? And Alex, that usually happens at around about $3,000 to $4,000. So if you're starting with two, we'll go into our Australian share and the bond ETF. Then with the next top up, it's usually between $3,000 to $4,000. We'll introduce that second defensive investment in the portfolio. And then we introduce the two global ETFs. So at around about $8,000, you're going to have all of those 5 asset classes and be fully diversified. But at least starting with those first two anyway, you've got exposure to hundreds of different companies here in Australia, as well as a bond ETF that's giving you defense and holds well over 500 different high-grade government bonds in the portfolio. Now, a next question is on fees. I mean, Hannah touched on that one earlier, the fee structure above 10K. Hannah, did you want to just mention a little bit more about fees?
Yeah, definitely. So I think one of the key points to reiterate is that Stockspot's fees are all inclusive. So whilst we don't charge these management fees for portfolio balances under $10,000, even once you do start paying fees, if the portfolio exceeds that, it includes things like brokerage costs, the advice fee, any portfolio rebalancing, your tax statements, which we will do for you every year, so you don't have to worry about the tax side of things. So that's an all-inclusive monthly fee that comes out. And what will happen is when we do invest for clients, we'll always leave a little bit of residual cash in the cash account, and that's to cover any potential monthly fees that might be being charged depending on the account balance, and for any potential rebalancing opportunities. But I would definitely recommend having a look on the Stockspot website. We do have different fee tiers for different account balances. But as I mentioned, for the most part, they are fee-free for those balances under $10,000. So having a look at some of the great questions coming through. So we've got a question here from Jess Irvine regarding declaring distributions and dividends on income tax. And then is this tax charged at my marginal tax rate? So Sarah, do you want to potentially touch on that question?
Yeah, absolutely. Thanks. And that's a great question, Jess, and one we get very frequently. So because kids' accounts are essentially in your name, so assuming you're setting it up in your name on your child's behalf, each year you're going to earn distributions from the ETFs in your portfolio. So that's essentially income. Think of it like a share, like dividend income. And you have to pay tax on that the year in which it's earned. So that is correct. So each year you would see a little bit of extra income that you would then be assessed at your marginal rate. But the benefit of the ETF portfolios is that a lot of the return comes from the capital growth component. Now, you're actually really deferring most of that until you sell down in the future or transfer the portfolio over to your children's name. And that's the point at which you pay a little bit more tax or have that tax liability. But however, you can access things like the 50% capital gains discount. But definitely it's always worth checking in with a tax professional or your accountant for any specific information around taxation advice. But yeah, in terms of income as well, Jess, you do also get the benefit of things like franking credits as part of that income. So that can help to offset some of the tax for you at tax time. So that's a good one to know. So we've got another question here from David. So more around tax. Ballpark figures around the cost to set up a trust for a child. So just to be clear there, David, so you would be setting up a trust as, a formal trust. So usually you'd engage your accountant to do that. It might be for reasons, for bigger, broader reasons, for asset protection reasons, or, certain tax efficiencies and things like that. So it's definitely worth chatting to your accountant if it's warranted for you to set up a trust, because you do have administration requirements for the trust each year, and that can come at a cost. Otherwise, you just do it in your individual name if there's no need for setting up a formal trust, and that's usually a family trust, a discretionary trust. And then we've got one question there from Mitchell, really, on insurance bonds. Mitchell, we did actually post a great blog on insurance bonds that really talks to the the caps of, you know, I know that you've mentioned that you mustn't exceed 125% of the previous year's contribution. That's correct. But I don't know, I'd have to actually just come back to you with a little bit more detail on the ability to keep contributing to that. So I'll reach out to you after that session, but definitely check out that blog that was posted in the chat section. And then what else have we got? I did see one other question here from Bimol, just around defensive assets in Emerald. Han, do you want to talk to that one on 30% allocation to defensive investments in the Emerald portfolio, but how do we know the individual allocations for each of those between bonds and gold?
Yeah, absolutely. It's a really good question. So within all of the portfolios, you'll have a breakdown of growth and defensive assets. So in the Emerald, it is a 30% allocation to bonds and gold, and 70% is across the share market ETFs. For the actual individual breakdown of the different investments, what you can do is actually, if you start the application for a Stockspot Kids account or any account, you'll actually be given the investment agreement, and that will include a full table breakdown of exactly which ETFs we invest in and also the specific asset allocation. So you'll be able to see what percentage we allocate to gold and bonds, and this is not just across the Emerald portfolio, but for all of the portfolios. Now, there's certainly no obligation to proceed with actually setting up an account once you get to this stage, but it's all just part of the initial questionnaire and sign up and application. Once you're given your investment agreement, you can look through that, have a look at the weightings there for a bit more information, or alternatively, you can always reach out to our team as well if you have any specific questions around that asset allocation for any of the portfolios. But that's where you'll find it as part of that application, Bimol. Great question. And I see we've also had one come through from Michael Steengard regarding reinvesting distributions or dividends. So in terms of the ETFs that we invest in within the portfolios at Stockspot, the majority, in fact, 4 out of 5 of the core ETFs will have dividends that are paid and can be reinvested. The gold ETF, which is unique as it doesn't produce income as such, so that won't have distributions that will be reinvested, but the other ETFs will. So what will happen is those are paid into your cash account, those distributions. Now, typically that's every 3 months. So every quarter, there will be some income. If you're in a sustainable portfolio, it might be every 6 months that most of your dividends come through. And so long as that triggers that next investment amount, which is typically $1,000, that will be reinvested back into the portfolio. Now, we do have an alternative for those who do want to draw down on dividends, although what we find is the majority of kids' accounts are not investing for income, they're actually investing for capital growth. So you really want to be investing that money back into the portfolio to help with that compound growth.
Fantastic. Wonderful. And I think there's just one other question that's come through from Andrea, a really important one. I've already set up my Stockspot account already. How do I actually get started? That's a fantastic question. So Andrea, you should have actually been emailed your cash account details. So check your inbox for an email from us if you remember when you completed your application. Otherwise, the other way to find your cash account details and make your first deposit is inside your dashboard. So you can access that already. If you head to the website and hit login, pop in your email and password and you'll be inside your dashboard. If you go to transfer money and then click on the deposit tile, you'll actually see your BSB and your cash account number in your name and the reference number. And you can go ahead and make a transfer from your external bank over to your Stockspot cash account. It takes about 1 to 2 business days for the funds to clear. We'll email and let you know that we've got that deposit, and then we'll go ahead and automatically invest that for you into your portfolio. And then if you wanted to, you can go ahead and set up that automated regular transfer over to your account. So it's set to autopilot and you don't need to worry about it, ongoing. So looking at time, I think that's time to wrap up today. There are a couple of questions there we haven't got to. Don't worry, we'll definitely get back to you over email, or we'll give you a buzz after the session. We'd like to thank you so much for tuning in today. If you would like to access any information, please make sure you head to our website, stockspot.com.au. You can check out our Investing for Kids page, or if you have other specific questions that come up, contact us at inquiries@stockspot.com.au. Otherwise, you can always give us a call on our landline, and Hannah, myself, or Shreya and the team will be very, very happy to assist you. So thank you so much for tuning in. We hope you found the session helpful, and we look forward to chatting to you all soon. Have a great afternoon, everyone.
Thanks, everyone. Take care.